people listening to this that don't know you, would you mind giving a brief introduction, who you are and the company you're here speaking on behalf of?
So I'm Marko Sjoblom. I would classify myself as a former athlete, because that's probably the one that I would like people to know me of. But of course, it was American football, played that professionally. I'm a European champion, and at the time the best player in Europe. But it's not that big of a sport in Europe. But that's kind of like how I would classify myself. But I'm a bit of an academic as well. I have a PhD in AI, and I've been collecting these degrees. The company I represent is called Fiinu, and we're listed on the London Stock Exchange, AIM Market. We're a fintech company focusing on financial inclusion.
And so to paint the picture a little bit, Fiinu was founded in 2017, 2018?
Correct. 2017.
2017, and then it first listed in 2022?
Correct.
And then delisted?
Well, we didn't delist, we did a reverse. So it's this technical relisting just now in August.
Okay, fantastic. And so you've got, there's two interesting chapters which we can compare and contrast in this conversation. So maybe before we get to that though, in the 3 to 4 years that you've been involved in public markets, what has been the best piece of advice that you have received in your capacity as a public leader?
I mean, there's a lot of good and there's bad advice as well. We can talk about those as well. But the best advice I've heard is stick to your guns. I mean, stick to your strategy. Don't start deviating or reacting to every little thing. Markets tend to be reacting very quickly on things. And I've always said it's a long-term game. First of all, to set up a bank, as an example, it's not something you can change in a couple of months. The process that we went through for Fiinu Bank here in the UK took 5.5 years. I mean, I didn't expect that to take that long, but my point is, it takes a long time to implement very good foundations and strategies, and therefore you need to stick to those. Stick to your guns, basically. That's, in a nutshell, the best advice I've been given to. And don't start waffling around on this and that, on jump, there's this, whatever, and because that's, you just then it's the tail wagging the dog situation where, there are so many opinions out there. And if you're not really true to your own strategy, people will sort of figure that out at some point.
Well, you've sort of teed up something that I wanted to talk about a little bit later. So let's start with that now, which is any growth business is needs to be very long-term oriented. It takes every billion-dollar company looks like an overnight success story,
Exactly.
But is usually 5-10 years in the making. Particularly in highly regulated industries where even if you are fully willing and able to move within a week, the system around you certainly will not. The market, however, public markets are not. Share prices change during a set window every second of that day, and so they can be a little bit more short term. How have you found balancing, and that might be what you're getting to, apropos the good advice, the long-term nature of what you need to be doing versus the short-term nature, what I think is the short-term nature of the market?
Yeah. It's tough. I'm not going to deny that, because we're all tempted to sort of observe the share price every day, and when you see fluctuations or volatility, going against you, you feel sad.
How often do you look at the share price?
I daily.
Yeah.
I'm not going to deny that. Of course I do, and but at the same time, it goes back to that good advice, which is like, in those, and I've tried to explain this to various, stakeholders, new staff, or the company that we just acquired, as an example, people that we've sort of bought, for a better word, they don't have any public markets knowledge. So therefore, I've tried to explain to the key leaders, if you like, that look, there are good days and there are bad days, and when the share price goes up by 50%, you feel over the moon. I mean, this is kind of volatility that we're seeing on our stock or our price. But equally, when there are those down days, just don't just go back to the drawing board and say, we now have set a 3-year plan. we've set a target for the share price, which is my personal sort of a bonus target. Just, these are meaningless numbers, but if we're trading at around 10p today, and we did the exchange at 10p, and we went to about 20, and now we've come down to about 10, having done a couple of raises at 15 and 20 as well. The fact of the matter is that my target is 110.
Right.
That's a 3-year target. So don't just ignore it almost. But it's difficult. We're still, humans.
And so, I mean, that's an interesting point on how you manage that with employees. And share price is an important measure, but at the end of the day, it can go up just as quickly as it can go down.
Yeah.
And internally, it sounds like a lot of the metrics and initiatives you have a target towards that long-term lens. What about with investors? Because some of them do have shorter-term mandates and requirements. Have you come up against any conflicts where they have demanded more short-term results or action, and that's conflicted with a long-term plan that you've had?
So we are very lucky that we have, first of all, round numbers, 80% of our shareholding is in what we call sticky hands. So these are concert parties, or just those that are maybe a little bit outside of our concert parties that we know, sort of beyond friends and family, people that trust us and have trusted us to deliver for many years already. But then there are some kind of like a newer investors. So as an example, this week is a good example. We about a week ago, I think, we closed a small round at 20p a share, and now that we've started, share price tripled to about triple, not triple. Anyway, go down to about 10p. I had to have, I think I've had 3 calls, one this morning and a meeting on Monday to explain what's happening. When the share price goes up, they're not calling you to explain anything. And so again, these are in a good spirit, these meetings so far. It's a lot of hard work because people obviously, sometimes they jump to conclusion, or they ask, and you can't share information that isn't in the public domain. So it's a balancing act. But as I said, we're very lucky with our very stable shareholder base, and I'd like to keep it that way. Because at some point it's not going to be possible. When you grow, then and hopefully you're sort of a $1 billion company. You get different types of people involved. You get short sellers as well, overlooking your stock. But then you get index funds involved. If we were, as an example, to uplist in the main market, that index funds will get involved. When the market cap gets to different levels, there are different, mid-cap investors that will always invest. So you kind of like go and tell the story to a different audience. But so far so good. We're managing it well, in my opinion.
It is, you mentioned before that sort of 80% roughly is held by concert parties, investors directly.
Yes,
and
correct.
so you're able to, what I'm inferring from that is they know you, they have a full understanding of the business and the context, so they're more likely to be able to be patient.
Yes.
Now, that's very good, but there's a bit of a double-edged sword, because 100%. It means that the 20% is a much smaller amount, which is freely trading, and so you're probably going to end up with more volatility.
100% correct. And that's the downside of such a large percentage being in sticky hands, because let's just say, although everything is in the free float, but in a technical free float, you only have, say, 20%.
Yeah.
And of the 20%, I don't know, maybe only 5% is actually trading hands.
Right. But that's probably like 70% of the volume.
Exactly. Yeah. That's the challenge. And you've got a lot of day traders. I think we've got a good following overall. But I don't know who these people are. I'd be very happy to meet, organize some sort of forum where people come and talk to us, etc. And I would always encourage people to reach out directly, and we talked about that before this this recording, that nowadays publicly listed company CEOs are basically available anyway. You can always reach out to them through social media, so I might as well give my number out. So it doesn't make any difference to me, really.
And it's not just that they are available because everyone's more available. It's that I think those, let's say that 5% that's freely trading, and that probably represents individuals that are going through this investment process on their own, the relationship that they expect to have with public companies and public figures is very different than it used to be. Yeah. Much like the relationship we have with any brand is very different. Yeah. It's more connected, it's less mass marketing, and that even in the last sort of 5 years, I imagine has noticeably changed the way you have to speak to the market.
Completely, and also market has shifted. So when we first listed 2022, market was in terrible condition, first of all. This was I think we were one of the last to list in the AIM market.
You picked a pretty bad time to list.
It was the worst of the worst. We still managed to raise £14 million at that point. There was some debt, but mainly equity at a reasonable valuation. But there was had we had other things lined up, I don't think that was an optimal time to list. And I think we've seen this downfall of people not listing at all. Now we're seeing, I'm at least sensing the pickup. I think most of the people who are following the market closely are seeing, if I look at some of our sort of peers within fintech space that we categorize with the likes of Revolut, a few others, they're all eyeing for listing, and I think that's the right thing to do at this time. Which market, but timing is not really about. It's less about which market; it's more about timing, in my opinion.
I think that's right.
2026 will be a good time for all of the companies to do their primary listing. But of course, it will also help the existing companies because there's already, we can see that in the small cap space in the UK, it's been undervalued, and we're seeing influx. And I'm feeling that influx because we're being contacted by various different parties, especially North Americans, asking questions, different calls. So it's less about outbound, which 22 it was all about us trying to sell. You go and do your roadshows and see 200 companies in a matter of a couple of weeks. It's hard work, and you're the one who's asking for money. Right now, tables are turning a little bit. People are approaching the likes of us, saying, "Can you tell us your story? Are you looking to raise?" And that sentiment is very positive.
Well, it's great to get some positivity because quite often these conversations end up circling around the negative. That being said, I am going to sort of flip it to a slight negative. We had a great conversation on the best advice and playing that out. What about the worst advice that you've received in your capacity as a public leader?
Not necessarily as a sort of public company, I wouldn't want to say that we've had a really terrible advice as a public company, but as a public figure, I would say, one of the advice that I was given earlier, that I have to pay attention to the smallest of the things that happen in the market, such as there are some forums, as an example. Where people talk about your share, and I put my hand up and I've visited some of those. I think there are some, especially here, that are very known to the market. You go in there and you realize, okay, if this is a rabbit hole, if you go into forming or helping any of your core thinking through what people are saying publicly, it's like you start forming your strategy on Twitter discussion. That's not going to end well. So therefore, I've taken that advice and I've put it in a bin. Say that's not the way I work. I'm a long-term thinker. I believe in execution of sort of a strategy, step by step, showing regulation. These all take time, and then short-term swings. Well, just going to have to live with them, but don't pay attention too much. And that was advice that was given to me. You have to pay attention to these small public forums, etc. And I don't agree with that.
That's interesting, because I mean, we could dovetail that back to the best piece of advice, because there will be, I mean, one thing there's a certainty in running a public company is you'll get unlimited inputs and you'll constantly be getting advice and input from people. And not all of it is fantastic, and not all of it you can do, because if you did, your sort of strategy would look a bit like this, and it wouldn't be very cohesive. And so I think it's a good approach to be aware of these things, but not necessarily duck and weave to accommodate all of them.
And just to be clear, I don't want to avoid such discussions. Quite the opposite. That's why I said about the openness. I believe that that's where we're heading anyway. You have to be open to communication with various different stakeholders. Now, I think there's a better way of doing that. Yeah. It can be structured. We could organize things, people should attend our AGMs as an example, questions. And we as a company could obviously organize such forums. But then there's the other side, not many people actually want to show up. But there's a balance between the two. So in my opinion, it needs to be structured. But there can also be unstructured elements where people can ask whatever they like. And I take a lot of calls from random investors. They sometimes call our switchboard and then they get diverted to me. And I don't think I've ever said, unless I've been in a meeting, no to somebody wanting to learn about the company. I'll just talk to them. And, as the good old BT said, it's good to talk.
I think that's a fantastic way to approach it. And I think going back to the forums and social media, I think incorrectly some participants in public markets see that is a very negative part of the system that shouldn't exist. I disagree in that I think it is those conversations, people airing grievances or talk, that always happened. Yeah. It's just happening in a different place than where it did 15 years ago. And what's more, why I think it can sometimes become I'm a bit curious to get your view on this, why I think it can become a bit unproductive in a forum is because a forum is a social channel wherein the company that they're talking about has no formal right of reply. And it can quite easily become an echo chamber where you get one very loud voice that tries to drag the sentiment in a certain direction. And what tends to fix it, in inverted commas, is direct engagement, where you give people the context and the time of day and answer their questions. And they say, oh, why is Marko getting paid so much money? And you say, well, look, here's this, and here are the comparables. And they say, oh, okay, that's quite reasonable. Yeah. And then it's fixed.
And on that note, I mean, my previous firm, which was doing pretty much the same thing as what Fiinu intends to do in terms of the plug-in overdraft, we had these times, so we had 5 million customers in the UK, retail. So I initially, we were so small that I was also taking calls in the call center, but I then put aside always a time of the week or sometimes a month when I was literally sitting there taking calls, talking to customers. So I think keeping that closeness is important. But to set your strategy on public forums is definitely not the right thing to do. You need to stick to your guns. I believe that is a longer term, better way, of course, doing things. But I would always encourage people to reach out, and that open communication with the company or directly with me is welcomed. I would actually love that. It's people shouldn't be afraid of, if you're a public figure or public company. You can't nowadays, in my opinion, you can't hide. Yeah. You can. Everybody can reach you through social media anyway, and that's my point about. Well, here's my number. Give us a call. Send me a WhatsApp, and I'll take the call. And that to me is a good approach. Yeah. Of course, a lot of work because there could be hundreds of people wanting to talk to you. And
but that's part of it.
But it is part of it. Yeah. And of course, then at some point, when that cohort of followers or investors grows, when the business grows, we would then I would like to think that organizing events or forums which are structured. I mean, AGM is a typical place where people come and talk and ask questions, but this is a good way forward.
No, definitely. So let's compare and contrast the two experiences you've had. I'd say initial listing, and then, for lack of a better term, the rebirth now.
Yeah.
When you approached that second chapter recently, and we're reflecting on the first, what are let's go through some things that you wanted to do the same, and some things that maybe you wanted to do a little bit differently from a public markets perspective. So what did you come away from that first chapter thinking, I'm going to do that exactly the same? That was fantastic. Let's definitely continue now.
So the major difference between the two was, first of all, and so let me maybe start with the latter one. So why did we do this transaction that we just closed on the 27th of August, rather? So we wanted to set a foundation for the company, so that it's sort of like, we could almost think or say that if all else fails, you have a solid business foundation generating revenue. It's a profitable business, and we can build a valuable, public company just on top of that. I think we could probably build. I wouldn't want to give any specific numbers out, but sort of a double of our valuation just on that business, because it has a very large order
Obviously,
book.
no financial advice.
Yeah, I know, exactly. I'm not suggesting that this is any financial advice anyway, but it's about setting a foundation. Now, all of the other things, technology-wise, etc., that we're doing, they had some uncertainties at the time. It's very difficult to get a bank to adopt a completely new technology, but we're in a good place now, of course, now having signed. First time around, there was a sentiment in the market a couple of years earlier that even if you're a pre-revenue bank, you're still deemed as success, because you've gone and navigated through the Bank of England process.
Right.
And that might have been the case when the Monzo, Starling, the others, Revolut, not in the UK at that time, but elsewhere, managed to get their banking licenses. There were a lot of investors giving all of them a lot of money. They were making huge losses, hundreds of millions, and they were raising money at good valuations. But that shifted very quickly between sort of COVID and then the war. And then when we were there, this was no longer the flavor of the month. So pre-revenue bank was kind of like, nah, it's not really of interest to us, anybody that is in the market. And that may change again. So sentiment is very important. So pre-revenue is a very unusual thing to do when you do a listing. It's a little bit like you've got some sort of a drug coming out.
Yeah.
You may be waiting for the FDA or the UK approval from the regulators. But once you get that approval, you can start trading, you can start selling that revolutionary drug. Banking license is similar. So when you get that license, you can start trading. You can't really do trading until you get that. And it's a lengthy process. So those are the major differences, of course. And we still believe that we will have a bank in a way or another. But let's not talk about that too much right now.
Okay. And so in terms of, let's talk about the way that you're engaging with the market and investors. Are there some things that you wanted to do differently or the same this time around?
I think so first of all, now, because we're now revenue generating, and so we do definitely want to inform people on a regular basis. We just had an offsite yesterday and we discussed the standard is to do half a year reporting. So we were thinking, well, nothing prevents you to do quarterly reporting, as an example, and we have such good systems that we could actually do that. So right now we're contemplating whether we should, because there's a lot of good information that we'd be able to share with the market.
And it keeps people more on the
more
journey.
Engaged. And kind of like, they would see, where is this heading?
Yeah.
And but like I said, we haven't made up that final decision, but it was definitely something that was discussed at length yesterday. I'd probably recommend that we do that. But you then just need to keep it quarterly then, for quite a long time at least.
So I suppose I could re-encapsulate that as increase, and this sort of goes back to what we were talking about before, that it is important to create a venue or channel through which people can talk to you, to just, you're looking at whether it ends up in quarterly reporting or something else, or organising opportunities for people to meet with you in person.
Yeah.
It is more communication and leaning into that more.
Yeah,
Is that fair?
It's fair, and it's this sort of like multi-channel approach that I think you have to have.
Well, everyone's different.
It's a hard. You've got different types of stakeholders, obviously. So there are some. The old-fashioned world still says, "Where's your research?" Okay, so I'm sort of like, nah, I'm not sure that's the right thing to do. But there's a scholar. There are parties in the city who still think, well, I'm not going to invest until I see research.
Right.
You could argue against it. I'm not personally great advocate of research, but it could work for some parties. Then you've got the other end, which is the day traders or retail punters, for a better word. They are not very. They are quite. I'm trying to be careful with my words.
They've got different. Maybe I'll help you out here. There's different. People invest in different ways.
Yeah.
And if you're in an institution, you probably have an analyst and a team that can prepare a model and make a fundamental analysis of the business, and do that whole process start to finish on their own and independently. And the research might be a helpful starting place for the model, but there's greater capacity within the organization to do that. My experience with retail has been that, and they're not all day traders, I would challenge you on that slightly and say that every day trader is also a long-term investor. Yeah. It just depends which part of their portfolio you fall into.
Yeah.
And they are going through that process on their own. And so, when I make an investment, for example, and I've got a little more access than the average person, but in a growth company, it is a lot more emotional.
Yeah, I agree.
Than it is fundamental.
Yeah.
And a lot more emotional than it is fundamental versus an institutional investor.
Yeah.
And so the channels, and this might be what you're getting at, are different. And the way they process information is different.
It's also how sometimes things are communicated. Yeah. So the RNSs tend to be very factual, almost quite boring.
Very sanitized.
And then if you're not professional investor, you don't necessarily understand what certain sentences even mean. You just focus on, it says that's it.
Revenue up, revenue down.
It's so black and white, whereas we know that, almost like every sentence has gone through a scrutiny. You actually think very carefully what you put in. It's not just something that just put out. And the RNSs tend to be, in my opinion, bit on the negative-ish side, the way they've been presented.
Conservative.
They're factual. They're so boringly factual. Yeah. I'm not going to say anything negative about our regulator here, quite the opposite. I've learned a lot from that. But sometimes the retail investors don't necessarily read in between the sentences, which is an art itself, which is what your professional analysts would know.
Exactly.
When they read the research and they read an RNS, they know what that means in practice, and then they'll write their report. Because when we have calls with analysts and so on, they are very educated. They know exactly what certain things say, because there is a way how you say things without saying things.
And great example for you guys, it might be, this quarter or this half year, R&D costs shot through the roof, we lost money. And to someone that had been following it, they might know, well, yes, because we said we needed to do a lot of infrastructure build so that next half we can start making money. But to someone new to the story or industry, it's connecting the dots and the context that might not be apparent.
Yeah.
And so maybe, and this is something you were talking about before, apropos fielding calls and giving that context, what I think retail investors sometimes don't get is, if you sit down with the institution over lunch and you explain what's happening, you don't give inside information, but you give a lot of context.
No.
And that the average person doesn't get. They just get the RNS.
Yeah.
And so that's the part that can be missing, is what does this actually mean and why are we doing it?
Yeah, and there are these, we did one RNS recently where we After we did a 20p round, we explained that we've done a convertible with our white label, and in that RNS, as an example, we're saying this was negotiated as part of the deal.
This was the one at 10p.
Exactly. And so what does it mean? It actually means it was negotiated when the share price was below 10p. Of course, it's come out now. Nobody publishes anything until it's signed.
Right.
But you have to use the word negotiated.
Yes.
Because at the time, if it was agreed, you would have announced it. So it was negotiated at the time. And so these kind of small little subtle messages or words almost are important, because you have an obligation to inform the market under the AIM rules, if and when there's something physically signed, as an example, or agreed immediately. There's no lag. And of course, we have a good nomad that is helping us actually in that process. But sometimes, I call him in a jokish way, the business prevention department. But in a good way. It's not a negative.
And nomads are a very important function of the market.
But the way they write things is very different to the way we would write things. So
and that might be where the supplemental information, whether it's like you explaining it on a video or something like that, can be very helpful.
But I just want to emphasize that our relationship, as an example, with our lead regulator is, in my opinion at least, you could ask that from our nomad, but I think it's brilliant. And we quite enjoy working with them. It's very productive, because we learn all the time more of, I think it's the same with every public company CEO. Unless you've been around the block and you've been in, this is the first one for me, so I'm learning all the time.
There's no guidebook to how to run a public company.
No, it's a very rare thing, first of all, to do. That, okay, why don't you go and become a CEO of a publicly listed company? They're like, okay, so what do I do? I don't know. There's a book, read it. CEO,
That could be good. Maybe we should make one of those.
Yeah, maybe.
We could put all of these interviews
What's
into...
this, publicly listed company book for dummies.
How to run a public company for dummies.
Exactly.
That's an idea.
Yellow book.
If whoever publishes those is listeing, we've got a corpus of information we could feed into it.
You would be brilliant actually collecting that, and here's an example of how not to do it.
Well, let's change tack slightly. So we've talked a lot about how the markets are changing. I think in general the world is changing a lot, and those revolutions of change are getting more compressed, they're happening more frequently. I expect that to continue. You have seen that change from chapter 1 to chapter 2 with your business. Are there any skills or activities that you think will become even more important in 5 or 10 years' time? And so we're sort of projecting ahead for other public leaders that might be listening to this and thinking, well, not just how do I get very good at doing what we need to do now, but how do I think about what's going to be important in the future?
Inevitably, we all know that AI plays a huge role. I started my PhD in AI in 2016 when it wasn't really a hot potato as such, and I defended my thesis in 2020. So I've had that for quite a few years. Even in 2020, it wasn't that big of a deal.
It's happened very quickly,
And so that's one of the elements. But then there are some other things, specifically in financial services. One of we're huge advocates of open banking. So there's a PSD3 coming through. Already PSD2, this is probably such a huge thing that people don't really understand what's the impact of that. We're all over it. We're reading papers. We're just like studying and researching more and more and more. And of course, our core banking product is tailored, is designed around open banking. So the implications of regulatory or standard changes driven by EU in this case, but UK has adopted that even faster. So UK is in the forefront of that in the world. That's not going to go away. It's a little bit like AI, but AI, the use of it, you can use it in so many different ways. And that's sort of like, it's like everybody needs to take that for granted, that it's not going to go away. You need to learn how to use these tools effectively. But then standards like PSD3, what's the impact of that? Because those standards will have some unintended consequences always. It's the same when we had the major overdraft reform in this country. We were able to predict that it will have some massive unintended consequences. And if you do that right, you always open up yourself for huge business opportunities. But it's a financial services focus.
Well, if I could extend that out, maybe because of the changes legislation, regulation, there tends to be a lag between technological innovation and the regulation that follows it. If I can tie that together and then link it to a broader PLC lens, whether it's AI or what's happening in open banking, there has been a great deal of innovation in the last 5 years that only just now the regulation is catching up to. And so for public leaders, not just in financial services, but in general, that next wave it sounds like probably coming now in the next year or two. And that will, not just for financial services, but more broadly, really change the way everyone operates in this public market sphere. Is that fair to say?
It's fair to say, but the way I would put it is, if you think of open banking first and then AI later. So where we're heading here is we're inevitably heading into unbundling type of world.
Yeah.
And so if we look at our core product, which is a lending product, this has been unbundled now. Nobody has in the 300-year history of overdrafts unbundled that. It's almost been part of your current account. But there are a number of other products I can see that will be unbundled in a way or another. They are too attached right now, and it's logical that when the infrastructure, the standard sets a possibility for you to do that, the consumers will always go for the better offer. Yeah. They're not going to stick with a bad offer from a bank or utility provider or whatever. So that's inevitable. Consumers will always find the best offer because that's how we are as humans. Why would you pay extra for something when you can get a better service from somebody else at a cheaper price, basically? And so that brings us to technology. Now, AI, as an example, allows or enables some of these things to happen. So in our case, it's specifically the underwriting method. It's driven by AI agent that we've developed, and it's our bespoke thing. Now, you can do that on the back of the fact that open finance exists. Without that, you can't do it. So it's kind of like, but you can predict some of these things already. You can see, okay, that's going to happen next. And then if you're creative and innovative with technology, you can supplement that, and now you can utilize that framework. Because regulators or policymakers, they are setting the frame for you then to go and innovate from. That's the kind of the way it works.
That's interesting. I mean, it speaks to a lot of what we talk about internally with our business, that the foundations are really set at the moment for, particularly in financial services and public markets, that next wave of, I refer to it as disintermediation, but it's not massively dissimilar from unbundling, where it is becoming easier and easier for constituent components to be done without needing huge centralized infrastructure. And that will lead to a lot of innovation and efficiency. And it's becoming easier for a consumer or a bank to plug and play.
Yeah, and this is all people. I mean, if you think of the sort of a younger generation who, born with mobiles in their hands, it's this omni-channeling that is coming through. In other words, you don't care how many apps you have on your phone. You just use whatever you use.
You're not loyal to any.
You're not loyal to any. I mean, there's an interesting statistics from the Financial Conduct Authority that people are more likely to get divorced than to switch their bank. Well, why is that?
Is that right?
Yeah.
Do you know, that makes sense, because I keep seeing ads for all these divorce apps in London.
So yeah, it's more than 16 years.
Jeez.
So that's the divorce period. So the banking relationship is longer than that.
Our business is about disintermediation, which I suppose you could use as a substitute for unbundling. And that we feel, because in public markets there has been so much innovation and foundation setting work done by other businesses, but also by legislation, to then enable the different parts of capital markets to be done independently and more efficiently. I can definitely see that playing out, not just in financial services, but also more broadly as well. Well, let me just leave you with one final question, and I'm putting you on the spot a little bit here, but given the openness that you were referencing earlier, I'm assuming this will be okay. If there are other public leaders that are listening to this conversation and resonate with something you're saying, maybe they're in financial services, or maybe they're just going through this process of once again coming onto the market and thinking about engaging people a little bit differently. Your credentials are quite publicly available. Are you happy if other public leaders reach out to you and start a conversation?
Absolutely. I mean, yesterday we had the AIM Awards. I don't know exactly how many people attended, but probably 1,000 plus. So if there was a one CEO per table, there must have been 100 plus AIM company CEOs in that event. I had a chance to speak with quite a few. We've got there's a number of advisors who know different, not just the nomads, but reporting accountants, the lawyers, and so on. So they kind of like they glue people together, for a better word. Although they're expensive, but anyway,
separate conversation.
but there is that already happening. I also do speak regularly, time to time, with some other non-public sort of leaders, for a better word, in the digital banking space. And I must also give gratitude to a few people that have always kind of been there for me when I've had down moments. Rishi Khosla from Oak North is one of those. This journey can sometimes be very lonely, and it's not always going according to plan. So it's very nice that some people offer that kind of like not a shoulder, but kind of like, okay, let's talk. I'll help you, or I'll listen to you. So I'd be very happy to extend that and give that away, whoever needs that. So returning the favor, a better word.
And to your point before, there's no guidebook for how to run a public company, and some of the best advice or input will probably come from other people that have already done it. So if anyone's listening, please reach out to Marko. Well, anyway, thank you for sitting down with me.
Thank you.